the basics of loan amortization. When you look at an amortization schedule, you might get the idea it's complex, a lot of numbers getting thrown at you, but it's actually so simple. A moron like me can figure it out. So having some fun with the whiteboard today. To make this easy, we are talking about principal and interest only, so no taxes or insurance in this example. Simplifying a little bit, principal is money going toward the actual asset. Interest is what the lender charges you to borrow money. No down payment, again, in this example, just loan amount or principal, call it principal, interest rate, term, and I'm gonna go ahead and actually give you the monthly payment just to demonstrate how the amortization schedule works. It's really simple and straightforward if you know how much your monthly payment is here. So in today's example, we have $500,000 principal at a 3% interest rate. That is a 30-year term. Monthly payment here is $2,108 per month. Here's the key. The interest on a mortgage does not compound every single day, nor once a year, nor once every 30 years. It compounds on a monthly basis. So 30-year term, so 360 payments. Think of it like that. This is the entire concept really, and where people start going like, okay, decimal points, high frequencies, digits. The 3% interest rate is 3% over 1 year. It's not 3% every month, right? So you're actually taking this 3% and you're dividing it. I'm gonna write this down. Fun, like I said, fun with the whiteboard today. I'm gonna write this down. So divided by 12 for 12 months, okay? And that's going to give you, that equals 0.25%, which will be expressed differently in the equation later. So when making your first payment of $2,108 per month, you're actually going to take the principal that you owe, the full $500,000 principal, you're going to multiply it by, again, expressing this differently, move the decimal point over because it's a percentage, so 0.025, and that is going to give you, I know the answer already, sorry, I worked this whole thing out ahead of time because doing live math wouldn't go well. $1,250. So $1,250. That is the interest portion going into your $2,108 per month. So here, let me actually kind of set this up in a little bit of a triangle here. Your interest, that's an I for interest, $1,250. And then, $2,108, that's $858 for your principal, P for principal, okay? In this example, not exactly known for my spectacular handwriting. So $1,250 again, that is the amount of interest you are paying in your first mortgage payment, and the $858, that is what you're paying toward the principal. Now, your 30-year mortgages are fully amortizing, so of course at the end of 30 years, you'll have paid a total of $500,000 toward the principal. You might already know this, but your mortgage payment is front-loaded with interest. You might not know it. Let's be honest, we've all gone to car dealerships and stuff and pretended we understand every little part of the equation. Personally, I'm guilty of that. Hey man, I totally understand what you're talking about. But as you pay down the principal, right? Sure, the payment remains the same, but as you pay it down, the amount of interest goes down and the amount in principal goes up with every payment. Why is that? Why does it start with so much interest? Well, given the choice, the bank would rather get their money now rather than later. Thank you very much. But let's jump ahead a few years, right? So in that example, that was your first payment here, going into August 2021. So let's go ahead 5 years, August 2026, flying cars, the way of the future. Let's check it out. Payment is still the same, right? $2,108 per month, but now your principal, which I'm writing up here, is now $444,513.10. That's your principal amount that you still owe on the loan. So we are actually going to multiply that again by our 0.0025%. I don't even know if I'm on the screen anymore over here. So how much of that payment is interest? Okay, so that's calculator time. So it's going to be $1,111.33. I actually, like I said, figured this out ahead of time. I don't just do that math in my head. So $1,111 $113.33, and that can only mean that $996.67 are going toward the principal. So in a perfect world, I'll be able to show you an amortization schedule graphic in the video. Get it up there, Craig. See, the open secret is that a lot of these concepts in mortgages, auto loans, they're easier than you might think. The terminology can be hard to keep up with, but it's good to know. And then when you refinance, let's say, your payment is smaller, but you are restarting the principal versus interest amortization schedule. So a lot of people don't like that. Sure, your payment is smaller, but you are front loading interest all over again. But yeah, that's our new segment. It is Fun with Whiteboards. I'm Craig Power with Power Realty Advisors. Thank you for tuning in. Like and subscribe. Maybe even get wild, get crazy, buy a house. Just a little thought, just a little inception there. Thank you for watching.